Hello and welcome to the first Cushman Wakefield Vietnam Market Beat video. I'm Jonathan Tizzard from Cushman Wakefield Vietnam. Okay, let's take a look at the wider economy first. GDP is on course to exceed 5% this year. This is much lower than the figures we were seeing up to a few years ago, but we believe it is a much more sustainable figure as inflation is much lower and the economy is moving away from a low-cost manufacturing base with easy access to credit towards a more high-tech, higher quality export-focused economy. Whilst the export sector is performing well, especially the foreign invested enterprises, the domestic sector is lagging due to low productivity, impaired bank balance sheets and inefficiencies in several state-owned enterprises. Inflation has been kept at historically low levels, although we witnessed a higher than expected increase in August of 7.5% year on year, as recent increases in food and energy prices were absorbed. The government has been taking steps to increase liquidity in the market as a whole and to sort through the bad debt that's been clogging up the banks. Credit growth has seen a steady, if not overwhelming, increase, with the rate expected to hit 12% by the end of the year. But when we factor in inflation to this expected credit growth rate, then it is obvious that the real growth is actually much lower and is concentrated in the exports and agricultural sectors. The non-performing loans in the economy were said to have shrunk from 4.7% to 4.5% from June to July by the government, although it is widely believed that the true amount is much higher, and our house view is unchanged in that the speedy identification and the workouts of these loans will allow the real estate market and the economy as a whole to function more efficiently. Finally, the dong was devalued in June by 1%. The Fed recently announced that the buyback program is to continue unchanged after initially suggesting a tapering, so a further devaluation of the dong might not be immediately forthcoming, but another rally in the USD against Asian currencies could force the hand of the State Bank of Vietnam, so a further devaluation is likely before the end of the year. In Ho Chi Minh City, there is currently a limited supply of large regular floor plates. Large occupiers are limited in where they can relocate to. We believe that the market has reached the bottom and that improvements have already started to show, and we expect to have a busy final quarter in terms of leasing activity. We also believe there's the demand there for another Grade A office building, as there are currently only 10, and we are eagerly awaiting the completion of the Vietcom Bank Tower in 2014, which will provide 55,000 square metres of space with floor plates of over 1,000 square metres each. We're also witnessing the trend of tenants who moved out of the CBD 5 years ago, as rental rates reached their highest level, actually coming back into the CBD as rental rates approach the trough of the market cycle. We expect a recovery in the office market in 2014 and urge tenants to secure competitive lease terms before the market turns. In Hanoi, demand is depressed and supply continues to increase, which will act to dampen rental rates going forward. The trend of occupiers moving west to escape congestion and high rates of CBD will continue, although this will not appeal to all occupiers, as some sectors require a CBD presence, with perhaps only back office suitable to be relocated out west, as the time and cost of commuting and the proximity from clients proves to be prohibitive. Landlords across the country should be aware of leases quoted exclusively in Vietnam dong without any reference to the dollar, as the expected further devaluation of the dong, along with increasing inflation rates, will reduce real returns. Okay, onto the retail market. At one point, retail was the hot ticket in Vietnam, but it's become apparent that some retail properties are not attracting enough customers, and tenants are leaving. It appears some developers have got their facts wrong when designing their properties, with bad layouts and tenant mix the main problems. In addition, the products in many of the malls are priced too high for most of the Vietnamese people, and those that cater to the mass market, such as Saigon Square and Ho Chi Minh City, are doing well. Going forward, we see opportunity in the mass product sector, and there are a number of brands entering the markets in the near future that will cater to the masses. Aeon malls from Japan will open in late 2013, early 2014 in Vincom and Ho Chi Minh City. And we expect these sort of general merchandise stores inside of department stores to appeal to a wide range of people. Entertainment such as sort of game zones, cinemas are very important, and the success of a mall as they attract more shoppers and create a lifestyle for a shopping mall. Crucially, rents remain unsustainably high in many fringe locations, and a correction is needed in order to attract tenants. Developers need to ensure of their target customer base and the associated affordability ratios going forward to ensure the new supply that is coming in line is successful. Okay, in the investment market, Vietnam has witnessed an upsurge in activity in 2013, and it's been its busiest since the global financial crisis, suggesting a rebounding foreign investment appetite for Vietnam. Notable deals in 2013 include the Vincom building, sold from Vin Group to a local property company, VIPD, as well as Centrepoint, sold by Japan Asia Land to Mapletree, and the private equity firm Warburg Pincus injecting $200 million of equity into Vin Group retail. Operating assets, such as office buildings, are the most popular investment targets for foreign investors, notably Singaporean, Japanese and Korean, who want to reduce their construction and leasing exposure on new developments. However, there remains a distinct lack of available, good quality, well-managed, saleable stock in both Ho Chi Minh City and Hanoi. Well-situated development sites in both major cities remain sought after. However, prospective developers anticipate a 30 to 40% correction in land values before taking on greenfield development investments. This shift has not been evident in the market as of yet, so a lot of development still remains unfeasible. Therefore, 2013 will see the highest transaction volumes in operating assets to date, even though distressed assets have not been abundant, despite the ongoing non-performing loans of local banks. The lack of liquidity in the financial markets will mean there will be more for sales in 2014, but the uncertain legal infrastructure continues to cause barriers to entry for potential investors, as does the opaqueness of domestic firms. The residential market remains a two-speed market, with those projects undertaken by well-funded and respected developers performing well. Examples of these would be City Gardens in Vietnam district, Ho Chi Minh City, which sold more than 90% of Phase 1, roughly $1,800 per square metre. In addition, the Happy Valley project in Phu My Hung continues to sell well. However, there are approximately 27,800 unsold apartments in Vietnam at the moment, so buyers are not buying off-plan, instead preferring the security of looking at the finished product before signing on the dotted line. The low-end sector is performing well, helped by the government efforts in providing soft loans, along with developers realigning their designs and profit expectations to levels dictated by the market. This is reflected in the performance of Q3 2013, where nearly 80% of the stock sold or absorbed by the market was in this sector, with an average price of just over $700 per square metre. With increasingly attractive payment terms and a large choice available, the rest of 2013 and early 2014 is expected to remain a buyer's market across the residential sector. Okay, this concludes our video. If you have any questions about what you've seen, please do check our website or phone us, as we're here to help you. Many thanks for watching.